Iran war escalates, silver 120, gold $6,000, dark market, oil surge. The title is not a prediction. It is not a headline from the future. It already happened. While you were sleeping, physical gold touched $6,000, silver crossed $120 in China, and 150 oil tankers simply stopped moving, not because of war, because insurance companies refused to cover them. The Strait of Hormuz, 20% of the world's oil supply, functionally frozen. And the most dangerous part, Western markets haven't even opened yet. What happens when they do changes everything. Welcome to AYU and Ag, the channel where we read the economic map before most people even know the map has changed. Now, before we go any further, if you're watching this right now, do us a small favor. Think of it like adjusting the volume on your television set. It only takes one button. Hit subscribe. That is all. One button. So the next time something this significant moves in the world, you are not the last one to know. And tell us in the comments, where in the world are you watching this from today? Are you in Asia, watching markets move in real time? Are you in the Middle East, feeling this closer than anyone? Or are you somewhere in the West, still waiting for Monday morning to tell you what already happened on Saturday? Drop your city, drop your country, because today's story belongs to all of you. There are moments in history when a single piece of news changes the entire direction of the world. This was one of those moments. On a Saturday morning, while most of the Western world was still asleep, Iranian state media made an announcement that stopped everything. Supreme Leader Ali Khamenei had been killed, struck by coordinated U.S.-Israeli airstrikes. The man who had led Iran for over 3 decades, the man who was considered untouchable, was gone. State broadcaster confirmed it in 3 words. He has reached martyrdom. And before the world could even process that, a second confirmation followed. Former Iranian President Mahmoud Ahmadinejad also killed. A separate strike, a separate target. 2 of the most powerful figures in the Iranian government eliminated within hours of each other. Now here is what most people assumed would happen next. They assumed the news would create shock, followed by silence, followed by de-escalation. They assumed that losing its supreme leader would cause Iran to pause, to recalculate, to pull back. That assumption was wrong, dangerously wrong. Because Iran did not pause. Iran did not recalculate. Instead, Iran responded. Within hours of the confirmations, Iran launched 165 ballistic missiles, 2 cruise missiles, and 541 drones. Not a warning shot. A full military response. 152 of those ballistic missiles were intercepted. 56 drones were destroyed in the air, but 35 drones got through. 21 of them struck civilian targets just that morning alone. The UAE, a nation built on stability, on commerce, on being the business capital of the Middle East, had been turned into a war zone. 3 people killed, 58 injured from multiple countries, moderate damage to civilian homes and property. And then Iran did something that nobody had seen before. They targeted the USS Abraham Lincoln. An American aircraft carrier struck with 4 ballistic missiles. The Iranian Revolutionary Guards confirmed the strike themselves through state media. Whether those missiles connected or were intercepted, the message had already been sent. Iran was not retreating. Iran was escalating. And somewhere in the middle of all this military chaos, financial markets began doing something very unusual, something that serious investors and business decision makers could not afford to ignore. Physical gold and silver prices began separating from reality, and that separation would change everything. Most people watch a war and see destruction. They count the casualties, they follow the headlines, they wait for a ceasefire announcement. But serious money watches something else entirely. Serious money watches what the war costs. And in this case, the cost was not measured in lives alone. It was being measured in barrels, in ounces, and in the silent movement of capital across borders at 3 in the morning. While television anchors were still debating whether the strikes were confirmed, traders in Shanghai already knew. While Western analysts were writing their first drafts, physical buyers in Shenzhen were already paying prices that made no sense on paper, but made complete sense in reality. Here is what they understood that most people missed. When Iran launched 165 ballistic missiles into the region, when 541 drones filled the skies above the UAE, when a former untouchable supreme leader was confirmed dead by his own state media. The world did not just enter a military conflict, it entered a supply shock. And supply shocks do not wait for market hours out. They do not respect the closing bell. They price themselves in real time, whether anyone is watching or not. This is the part of economic history that most classrooms never teach. Wars do not destroy value overnight through bombs alone. They destroy value through uncertainty. And uncertainty has a price. That price showed up first in the dark markets, not dark in a criminal sense, dark in the sense that these are the markets that operate when official exchanges are closed, when nobody can officially set a price, when only the most informed buyers and sellers are left in the room. And in those rooms, this particular weekend, gold was trading at $6,000 per ounce. Not yuan, not a futures contract, not a prediction. $6,000 per ounce for physical gold. PXG, which is tokenized physical gold running on crypto infrastructure, hit $5,600 on Saturday. By Sunday, it was sitting at $5,400, still $124 above Friday's official closing price of $5,278. That gap of $124 was not noise. That gap was the market telling a very specific story. It was saying that the people who had access to real gold were not selling it at Friday's price under any circumstances. And if gold was sending that signal, silver was about to send an even louder one. There is a narrow strip of water sitting between Oman and Iran. At its most narrow point, it is only 33 kilometers wide. You could drive that distance in less than 25 minutes on an empty highway, but through that 33 kilometers flows approximately 20% of all the oil the world consumes every single day. 20%. That is not a statistic to read and forget. That is the number that heats homes in Tokyo. That is the number that powers factories in Seoul. That is the number that keeps the lights on across the entire Indian subcontinent. The Strait of Hormuz is not just a waterway, it is the economic heartbeat of the modern world. And this weekend, that heartbeat began to stutter, not because Iran fired missiles directly at oil tankers, not because a naval blockade was officially declared, not because any government issued a formal closure order. The strait began to freeze for a reason that most people never think about: insurance. Here is how it works in simple terms. Every commercial ship that passes through a high-risk maritime zone must purchase what is called war risk insurance. This protects the shipping company if the vessel is attacked, damaged, or destroyed. Under normal conditions, insuring a $100 million oil tanker through Hormuz costs roughly $250,000 per voyage. That is already an enormous number. But after 2 vessels were attacked and set on fire near the strait's entrance, after a Palau-flagged tanker named Skylight was hit near Kasab with 4 crew injured and 20 evacuated, after a second vessel named MKD Vian was also struck and left burning in open water, insurance companies began doing what insurance companies always do when risk becomes unquantifiable. They repriced everything. The cost per voyage jumped from $250,000 to $375,000 overnight. And many insurers stopped offering coverage entirely. When coverage disappears, ships do not sail. When ships do not sail, oil does not move. When oil does not move, the entire global economy begins running a fever. 150 tankers dropped anchor in open water. They did not turn back toward port. They simply stopped, sitting off the coastlines of the world's largest oil producers, going nowhere. Maersk, the world's most recognized shipping company, suspended all Strait of Hormuz transits completely. And Brent crude oil prices responded immediately, jumping 8 to 10% and holding every single gain through the weekend. This was not a spike driven by fear. This was a price driven by physical reality. There is a conversation that happens inside the world's most serious financial institutions. It does not happen on television. It does not happen in press releases. It happens quietly in the hours when official markets are closed and only the most informed participants are still moving money. This weekend, that conversation became impossible to ignore because something extraordinary happened across physical and crypto-backed metals markets simultaneously. Something that has never quite happened at this scale before. The price of real gold and the price of paper gold stopped agreeing with each other, and when that happens, when physical markets and futures markets begin telling 2 completely different stories, serious investors do not look away. They lean in. Here is exactly what the data showed. China's Dasheng Bank issued an official notice to its clients on Saturday morning. The notice stated that if price deviations became large enough to deplete accumulated gold liquidity, trading would be suspended entirely. Read that again, slowly. One of China's most significant commodity banking institutions was preparing for a scenario where gold demand would become so intense, so sudden, so overwhelming that they might not have enough liquidity to keep the market functioning. That is not a routine notice. That is a financial institution quietly preparing for chaos. And then the numbers started arriving one by one. PXG, which represents tokenized physical gold, settled on blockchain infrastructure, hit $5,600 on Saturday. By Sunday, it was trading at $5,400, still sitting $124 above Friday's official Western spot, close of $5,278. Meanwhile, the dark market, the market where physical gold changes hands between serious buyers when no official exchange is open, touched $6,000 per ounce. Not as a rumor, not as speculation. As an actual transacted price between real buyers and real sellers. Then silver told an even more dramatic story. A Chinese commodities trading advisor confirmed that physical silver buyback prices between small distributors in Shenzhen had risen by nearly $20 per troy ounce equivalent. That single move pushed Shenzhen's physical silver price north of $120 per ounce. IG weekend spot silver was trading near $100 Kinesis silver, also at $100 hyperliquid, showing $96 Shanghai spot at $105 Shanghai futures at $100. The Western spot had closed Friday at $93. That is a $27 premium in Chinese physical markets over Western paper prices. A $27 gap between what paper says silver is worth and what real people with real money are actually paying for real silver. That gap does not exist without reason. There is an old military principle that most modern strategists have forgotten. It was understood clearly by every great naval power in history, from the British Empire to the Ottoman Sultanate to the trading dynasties of ancient China. The principle is simple. You do not win an economic war by sinking ships. You win it by making ports unusable. Ships can be replaced, crews can be reassigned, routes can be redirected, but a port that is burning cannot process cargo. A crane that has been destroyed by a drone cannot unload a container ship. A terminal that has been struck cannot receive the fuel that keeps an entire nation's economy breathing. Iran understood this principle completely, and this weekend Iran demonstrated that understanding with surgical precision. While the world was focused on missile counts and drone interceptions, while analysts were tracking ballistic trajectories and carrier group positions, Iran was executing something far more calculated, something that will have consequences. Lasting not days or weeks, but potentially years, they were not simply attacking military targets. They were systematically dismantling the infrastructure of global commerce. The first strike that revealed this strategy was not Hormuz. It was Duqm, a port located on Oman's southeastern coastline, specifically engineered and constructed to bypass Hormuz. Entirely, Duqm was built precisely because the world already knew Hormuz was vulnerable. It was the backup plan, the alternative route, the contingency that gave oil importers confidence that even if Hormuz became difficult, Duqm would remain open. Iran struck Duqm first. The backup plan was eliminated before most people even realized the primary route was threatened. Then came Jebel Ali in Dubai, the single most important commercial port in the entire Middle East, handling approximately 60% of all UAE imports, not military imports. Commercial imports, the food, the medicine, the electronics, the raw materials that keep Dubai functioning as the business capital of the Gulf region. Drone strikes hit Jebel Ali directly, then Mina Salman in Bahrain, home to the United States Fifth Fleet, where military infrastructure and commercial shipping exist side by side. Struck to demonstrate that even American naval presence cannot guarantee port safety. Then Haifa in Israel, a port that manages critical energy imports for a nation already operating in full wartime conditions. 4 ports. 4 completely different strategic functions. 4 completely different nations. One unified message. No terminal is safe, no backup route is guaranteed. No amount of carrier groups can protect every crane from every drone simultaneously, and the global economy was about to feel every single one of those strikes in its price structure. There is a category of country that the world rarely discusses honestly, not because the information is secret, not because the data is difficult to find, but because the conversation is deeply uncomfortable. These are the nations that built their entire economic identity around the assumption that global supply chains would never truly break. They industrialized rapidly. They grew their middle classes with impressive speed. They became manufacturing powerhouses and technological leaders, all while quietly outsourcing their most critical vulnerability, energy security. And this weekend, that vulnerability stopped being theoretical. It became a live economic emergency, measured in real numbers with real consequences. Japan was the first nation where the arithmetic became impossible to ignore. 75% of all Japanese oil imports travel through the Strait of Hormuz. Not some of Japan's oil, not a portion that could be quietly substituted from alternative sources overnight. 3/4 of everything that keeps Japanese industry alive. Japan is also near 100% import dependent for energy overall, meaning the country produces virtually none of its own oil domestically. Japanese tankers were already turning back before Sunday morning, not because the Japanese government issued an order, but because the captains and the shipping companies made the only rational calculation available to them. An uninsurable voyage is not a voyage, it is a liability. South Korea sat in a nearly identical position. 60% of South Korean crude oil imports flow through Hormuz. South Korea is one of the world's most sophisticated electronics and automotive manufacturing economies. Semiconductors do not get manufactured without energy. Automobiles do not get assembled in cold, dark factories. And energy in South Korea this weekend was becoming something that could not be guaranteed at any price. Then came India, the world's most populous nation. The economy that every global institution had spent the last decade describing as the next great growth story, India sources 50% of its crude oil imports through the same strait that 150 tankers had just decided was too dangerous to enter. Roughly 26,000 barrels per day flowing from Gulf states into Indian refineries, plus 60% of India's natural gas and LNG supply moving through the same frozen waterway. Fuel prices in India were mathematically certain to rise. The rupee was already feeling pressure before markets officially opened, and GDP growth projections that looked so promising just 1 week ago were being quietly revised downward in every serious economic institution that understood what was actually happening. Here's the detail that most analysts missed completely. They were so focused on the missiles, so focused on the drone counts and the burning tankers and the insurance premiums that they forgot to ask a question that changes everything. What was the condition of these markets before any of this started? Because a war landing on a healthy, balanced, well-supplied market is one thing. A war landing on a market that was already running a structural deficit, that is an entirely different category of economic event. And the data on silver and gold before this weekend was not ambiguous. It was not open to interpretation. It told a story that serious investors had been watching build for months. Silver had closed green for 10 consecutive months, 10 months in a row. Not because of geopolitical tension, not because of war premiums or fear trading, but because the fundamental supply and demand equation for silver had quietly broken in one direction. Industrial demand for silver had been accelerating across every single sector that defines the modern economy. Solar panel manufacturing requires silver. Every electric vehicle produced contains silver in quantities that traditional combustion engines never needed. Artificial intelligence data centers running at full capacity consume silver through their cooling and connectivity infrastructure. Fifth-generation telecommunications networks are being built with silver. Military and defense procurement has been quietly absorbing silver at levels that do not appear in mainstream financial reporting, and the mines simply cannot keep pace. This is not a narrative constructed around fear. This is basic extraction, mathematics meeting exponential industrial demand. Then, silver lease rates began spiking. 6 consecutive days of rising lease rates before this weekend even began. Lease rates spike when the people who actually hold physical silver become reluctant to lend it out. When holders decide that keeping physical metal in their own possession is more valuable than the income generated by lending it. That signal alone told sophisticated market participants everything they needed to know about supply tightness. Gold was telling its own parallel story. 7 consecutive record closes, central banks around the world had been purchasing gold at rates not seen in modern financial history. Not 1 or 2 central banks making quiet portfolio adjustments. Dozens of sovereign institutions simultaneously reducing their dollar exposure and replacing it with physical gold. China's persistent Shanghai premium had been running at $12 above Western spot prices for weeks before this weekend. Then the war came, and that $12 premium became $27 in Shenzhen physical markets overnight, a deficit that was already serious. Every major economic disruption in modern history has contained within it a window. Not a window of panic, not a window of celebration, a window of clarity. A brief and unforgiving period of time where the data is visible to anyone willing to look directly at it, where the signals are loud enough to cut through the noise, where serious decision makers who understand what they are seeing can position themselves accordingly, while everyone else is still waiting for permission to believe what is already happening. That window was open this weekend, and the question that every serious investor, every business owner, and every young entrepreneur watching this needs to ask themselves is very simple. Were they looking through it? Here is what the complete picture showed when examined without emotion and without bias. 3 assets moved together simultaneously under conditions of genuine structural stress. Not paper stress, not sentiment-driven volatility. Physical stress, measured in anchored tankers and burning ports and insurance companies refusing to write policies. Gold moved because it has always moved when sovereign confidence begins to fracture. When central banks stop trusting each other's currencies. When the system that prices everything begins showing visible cracks. Gold does not need a reason to hold value. It needs the absence of reasons to abandon it. And those reasons were disappearing one by one this weekend. Silver moved because 10 months of structural deficit finally met a supply shock powerful enough to make the premium undeniable. The 2700 gap between Shenzhen physical prices and Western paper prices was not a weekend anomaly. It was a structural truth that geopolitical crisis simply made visible to a wider audience. Oil moved because 20% of global supply does not get replaced with a phone call. There is no alternative route that absorbs 150 anchored tankers overnight. There is no spare capacity sitting idle, waiting politely for Hormuz to reopen. These three assets were not spiking together by coincidence. They were spiking together because they are the three pillars that the modern global economy cannot function without. And all three were simultaneously under threat from a single geographic and geopolitical pressure point. For the business community watching this, for the entrepreneurs who understand that wealth is not built during stability, but recognized during disruption, the message from this weekend was not complicated. It was not hidden inside complex financial instruments or buried in technical analysis. It was sitting plainly in the data. 3 assets, 1 window. And the world waiting to see if Western markets would finally say out loud what physical markets had already been whispering all weekend long.